I'm Anthony Valeri, Director of Investment Management in Wealth and Fiduciary Services. April tax revenue came in lower than expected at the U.S. Treasury, prompting renewed attention on the budget deficit and the debt burden. Depending on the path of the budget deficit, it could have longer-term consequences for financial markets. Let's dive in. A common metric to assess the debt burden for most investors is debt to GDP. And U.S. debt to GDP using marketable Treasury debt is currently 99%. This is up from 80% just before the pandemic. The Congressional Budget Office, or the CBO, anticipates a gradual increase to 116% in 10 years, with a further increase over the next 20 and 30 years. This slow but upward advance is likely beyond the time frame of most politicians to take immediate action, but will likely resurface as an issue after the election. As an aside, there are various measures of debt to GDP. For example, if we include all corporate and household debt, that measure, occasionally cited in the news media, is in excess of 300%. But that particular measure is misleading in that it fails to account for assets that can be used to offset that debt. In a more positive light, excluding Fed holdings of treasuries and other treasury holdings of domestic investors, the debt to GDP ratio is 80%. On a related note, the US benefits from having a greater portion of its marketable debt held by domestic investors compared to most other countries. In fact, only Japan, Switzerland, and Korea have a larger allocation among domestic investors. That helps because a larger domestic investor base reduces volatility by reducing exposures to the whims of foreign investors, which could demand higher yields in the event of stress. This is one reason why Japan's debt to GDP ratio of 260% has not led to a debt crisis. The easiest way to lower our debt burden is to grow our way out of it through better economic growth, but better than expected economic growth has not been able to shrink the deficit in recent quarters, given still heavy spending and rising interest costs. In this chart, we show the budget deficit as a percentage of GDP on the left and the unemployment rate inverted on the right. After the budget deficit reached a whopping negative 18% during the pandemic, a strong economic rebound helped close that gap, but further improvement has been limited and the deficit stands at negative 6% currently. Continued government spending and rising interest costs has limited further improvement. This alone is not cause for alarm, but it comes at a time of very low unemployment. This is historically rare. Outside of economic growth, spending constraint is the only way to reduce that debt burden. And just to show what an odd historical combination this is, if we go back through history, we can show during recessions where the budget deficit was at a peak and what the corresponding unemployment rate was. And here we're using quarterly data. And if we go back to the 1970s, we see the budget deficit was a negative 4.3 with an unemployment rate of 8.9. During the 1980s, when the budget deficit was a negative 5.3, the unemployment rate was 10.1. And you'll see various other points from the early 90s to the great financial crisis when the budget deficit was at a peak, unemployment was much higher than its current level. The takeaway from all of this is that should the economy slow more than expected in the future and unemployment rate rise, the government would have less room to provide stimulus or even support basic government spending given that even larger potential existing deficit. Let's take a look at how interest costs have increased over recent quarters. This shows rising interest costs as a percentage of GDP. This is net interest as a percent of GDP, and certainly been a driver of a stubborn budget deficit. And with over $7 trillion worth of treasuries maturing in 2024, and that's a little more than 20% of outstanding treasury bonds, interest costs are likely to continue to increase as that lower interest debt is replaced with higher interest debt. And adding or compounding to this risk is that the Fed has pushed back on the timing of its first interest rate cut. This has only added to the likelihood of interest rate costs rising in 2024 and likely beyond as well. Increasing Treasury issuance, which could be a consequence of all this, played a role in the bond market sell-off of 2023, especially during the late summer and early fall. In August of 2023, the Treasury announced an increase in issuance for the first time in 2.5 years. And while not the only driver, it certainly played a role in the move higher in market interest rates. And then fast forward to November 2023, and the Treasury announced issuance that was lower than expected. The increase was less than expected, and then also announced that issuance would remain steady after one more increase, which was greeted well by the markets and helped contribute to lower interest rates over that time frame. Again, Treasury supply is not the main or the only driver. However, it did play a role in 2023 and may continue to play a role going forward. Longer term, there are two risks that investors should be aware of due to if debt dynamics do not improve. One, if the government is forced to issue more debt amidst a wide deficit, bond investors may require higher yields as compensation. Two, if the government reduces spending to help combat the deficit, economic growth may be hindered as fiscal policy becomes restrictive or unable to respond forcefully in the event of a recession. Neither is an immediate risk, but both bear watching in the month and years ahead as potential drivers of stock and bond prices. I'm Anthony Valeri. Thanks very much for listening. We'll speak to you again soon.